Hi, I'm David Buckland and welcome to this week's Video Insight. Today I'm being accompanied by Rob Forker. And for those who don't know, Rob is the Portfolio Manager of Polen Capital Global Small and Mid Cap Fund. Rob, you have about 8,000 stocks to choose from in the global space in the small to mid cap area, and you have to go all the way down to try and get the best 35 stocks or approximately 35 stocks in the world. How do you do it?
It's a hard task, but one we enjoy doing. So finding the best of the best is what we're all about. We want to find the most elite companies we can find globally wherever they reside. Australia, continental Europe, America, Japan, wherever. The way we do it is we apply our proven 5 guardrails that we've been executing at Polen Capital for almost 35 years. Those are real organic revenue growth, high and or improving margins, high returns, abundant cash flow, and a strong balance sheet. And at the end of the day, what we're looking for is companies that have strong earnings, have strong cash flow, and fortress-like balance sheets, because those are quality companies that can be durable over the long term.
And it's interesting, out of your portfolio of, I think it's 33 stocks at the moment, the average market capitalisation is about 8.5 billion Australian dollars, which actually would put it in the top 60 on the ASX and be similar size to something like Qantas or Mirvac. So it's interesting that for Australians, that seems quite big, but by global standards, they're still categorised as small or medium-sized type businesses.
Yeah, no question. So we find companies, of course, globally, and small cap, mid cap is a bit of an art as to what you define that. But what we believe is that the inefficiency of the asset class is clear. So a typical company that we're looking at in our asset class has 7 to 8 analysts. For reference, Apple has 55. And so the beauty of what we do is that we're looking at underexplored companies that we believe have a secret sauce. Now, it's our job to figure out what that secret sauce is, but we do. And as an example, one of the companies we have has no sell-side coverage, right? So this is, it's an opportunity and one that we relish in. That's
good. Now, one of the interesting graphs we get from Polen Capital is investing across the growth spectrum.
Yeah.
Where on one side of the spectrum you've got these very sexy, very high growth companies, but are earning money.
Yep.
And on the other side of the spectrum, it's a little bit more balanced in the portfolio. Can you just explain for the small and mid cap global audience investing across the growth spectrum and how you think about it?
Yeah, so on the safety side, these are typically consumer staples companies or healthcare companies where they're a little bit slower growing, low double-digit earnings, so still great, but slower going. Cochlear would be a great example. Fortress in their market share and their constant R&D, but typically grows earnings 12 to 14%. On the far end, we call these growth companies, and they typically grow earnings 30 to 40%. An example would be Buckland, which is an IT consulting firm at the forefront of what they do. They're basically a mini Accenture. And so those type of companies are growing faster. We want both, right? Because we appreciate the safety and the growth elements that can help you in bad times and give you outsized returns in good times.
So if we look at the fundamentals of the total portfolio, let's just sort of spend a minute or two on that.
Absolutely. So when you put it all together, this is a portfolio that trades at roughly 25 times earnings on a next 12-month basis. We believe earnings growth is nearly 20% per annum. The returns...
For some years?
We forecast out 5 years.
Okay.
That's our investment time horizon. So we want to think and act like owners, right? Think about these great companies, what they can do over the long term. The balance sheet is nearly net cash, so no balance sheet risk to speak of. As I mentioned, strong cash flows, right? We want companies that self-fund, which is actually quite unique in this space, right? Many small cap managers own unprofitable companies where they're betting that things will get great.
Have to go back to the market for equity.
We don't want to do that
on a regular basis.
We don't want to do that. We don't want to buy what will be quality. We buy what's proven to be quality today. And this is the beauty of the menu that we have of nearly 8,000 companies. We can be choosy. We want to own elite companies.
And I guess the elephant in the room, Rob, we launched this in Australia, although the fund out of America is actually, Boston, where Rob's based, is actually a bit older than that, but we actually picked the timing to perfection in terms of the peak of the market. So October 2021, so it's coming around for its 2-year anniversary, and it's been a very, very rough ride for the early investors. Yours truly is one of them. Let's just give it some context. It's obviously been a very rough 24 months. Do you want to sort of let's just spend a few minutes on that?
Yeah, and yours truly as well, right? So I eat my own pudding. I'm an investor. My children are investors. I am betting on the success of the strategy, as many of you are. The elephant in the room is that 2022 was bruising, just literally awful. We weren't certainly the only ones that had the bruising. This was a global phenomenon, particularly in small and mid cap. This year, what's been surprising is the bounce back has not been there. The strategy is certainly not doing poorly, but it hasn't had the type of returns that many of the large cap strategies have had. Small cap in general has been sort of left behind. What we focus on is the fundamentals of the business. We believe that earnings growth for our companies was 12% last year. We believe that earnings this growth will also be very, very strong, closer to that 15 to 20% level that I was talking about. And that's what we are focused on. PE multiples, as Roger and many astute investors talk about, PE multiples are confidence, right? They go up and down, but we believe over the long term that stock prices follow earnings growth, and that's what we think will happen over the long term. But certainly, we didn't want to start this way, and it would have been better had we not. But this is where we are, and therein lies the opportunity.
All right, ladies and gentlemen, that's all we have time for this week. As many of you know, we've had a very, very good relationship with Polen Capital for about 2.5 years now. Rob, Damon and many members of the team come out pretty much on a 6-monthly basis, and we have been blessed to partner with an organisation of such great quality. So thanks very much for your time. Please continue to follow us on Facebook and Twitter, and I appreciate your attendance.
Thank you.